as you can see, I belong to a team at SEB which has the fancy title Climate and Sustainable Financial Solutions. It sounds good, and it is good. We have so many exciting things to do. Among these things are to participate in discussions and panels and seminars like this. And most of the times we are invited to speak about the creation of green bonds, the development of the market, the DNA of the product, what's in it for different stakeholders, etc. But today we have the pleasure of hearing the real story from the guys who are actually doing it, who have the projects on the ground. From Gothenburg, from Kommuninvest, from Vasakronan, and after me we'll have Munifin sharing their experiences. So instead, I've been asked to speak a little bit about banking on green, responsibilities, restrictions, and drivers for financial intermediaries. And I'd like to start with a look back 2 or 3 years ago, when the term the clean trillion was coined by the North American NGO Ceres, who are summoning up together institutional investors and companies. They're focusing on climate, water, and sustainability issues. The clean trillion is the amount of money that needs to be added to investments in low carbon energy investments in order to meet the 2-degree target, or at least with an 80% probability. And that is based on a study made by the International Energy Agency. So that is a neat and a nice term and good to remember. The other starting point I would like to make is to refer, as some of the speakers before me have done, to the very important Paris Agreement, which I think you can argue brought us 2 novelties. The Paris Agreement implied a confirmation that the political leadership throughout the planet stands behind this high ambition. And it certainly lent a lot of credibility to the issue that individual stakeholders, NGOs, some politicians, some companies have been talking a lot about over the last 40 years or so. And one researcher from 1896. But since the Paris Agreement, confirmation of a clear message and credibility. The second novelty, I think, with the Paris Agreement is that finance received a position much more central in this climate issue debate than previously. And in parts of the Paris Agreement, they focus on 3 things. They focus on the 2-degree target, added the 1.5-degree ambition. It raises the focus on adaptation issues. And third, it says making finance flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development. So the financial industry is brought into center stage in the whole climate debate in a way that I think it's fair to say is different from what was the case earlier. This is a responsibility for the finance industry to take this seriously. Now, Bloomberg, together with Ceres, have looked into this the investment needs, focusing on the energy provision for the planet. And the clean trillion can sort of be displayed in this way. And here you see 2 scenarios. Starting with this in the last few years, the gray bars is the business as usual. So even without any additional focus or Paris Agreement, it was expected that investments in clean energy, low carbon energy, would increase. But to reach the 2-degree target, more than a tripling of these investments will need to take place over the next 10-15 years. Now, in this study by Bloomberg and Ceres, they also try to distinguish between the different kind of funding sources that may provide the money on the table to make these investments possible. And bank debt continues throughout this period to be the biggest individual source of funding. And then there's a lot of focus on balance sheet corporate debt, institutional investors in different fashions. But if you look at the purple part here, the part that is providing the biggest expected, according to these analysts, growth is asset-backed securities, green bonds, and similar. That's where we have more room for financial innovation, green bonds being one, but hopefully not the only example of that. The question then is, where is all that money going to come from? $1 trillion a year only for the clean energy investments. Is there money around? And the answer is yes. Money is not a problem. We have other problems matching the money with the needed projects. And this is one illustration, and I think that Björn had a picture of the principles for responsible investments as well. What we see here is a dramatic increase in institutional investors signing the principles for responsible investments. We're soon going to get the updated numbers, but the latest numbers we have is around 1,500 investors, together with assets under management equal to $62,000 billion, or $62 trillion. Is that a lot? Yes, it is. That's a huge amount of money, and compare that to the 1 trillion a year. And these are only the investors whose boss's boss, someone with a very high salary, have put their signature on a paper committing themselves and their thousands of employees to integrate ESG into their regular investment operations. Now, adding your signature is easy, but we're talking about thousands and thousands of portfolio managers, men and women just like us, go to work 8 to 5. They are the ones who are actually going to make this happen. And that's where focus should be. Now, if we narrow this down a little bit to the banks, the banks, if you go to your book of economics, have a crucial role in society when it comes to resource allocation, to transfer excess savings to where the most appropriate investments are to be made. And in a very simplistic way, you can distinguish between policy banks and commercial banks. Policy banks being like Kommuninvest, the World Bank, IFC, EIB, NIB, etc. I mean, they have a political mandate and a clear focus. They were the ones who started issuing green bonds, which is natural given their setup. Now, if we turn to the commercial banks, if the third point from the Paris Agreement is going to happen, commercial banks will have to step up to meet this challenge and to seize this opportunity. And I think one can, in a also simplistic way, distinguish between 3 ways to respond to this. It's either to continue with business as usual, or else to raise the flag and make some opportunistic investments or so. Or it's the third, integrated approach, to take this to heart, to the DNA. And I will give one example, and it happens to be from the bank where I work, which is because I know our business better than I know many other banks. But this is one example I think that qualifies in the third category there. And I'd like to turn your attention to the box to the left here. We at SEB are convinced that companies that include sustainability in their operations are more successful in the long term. Which clients do we want to do business with? Obviously the ones that are more successful in the long term. And this goes into the DNA of our activities. And we see this in the development of a number of sincere policies and strategies that will help our colleagues to allocate money in line with these policies. We're also developing products. We're helping clients to issue green bonds. We're now issuing green bonds ourselves and provide our clients with green loans. So Cities can get green financing from Commun Invest. They can issue their own green bonds. They can get green bank loans, depending on what is most appropriate. We're developing specified research, advisory, and as mentioned, we're helping China, India, Brazil, and Mexico by providing advisory and workshops. Now, to add ESG risk to financial risk will give you comprehensive risk. And if we are right, it will also give you comprehensive returns. What is needed for this link is a transfer of information. The portfolio managers are financial experts. The green bond, as we developed it together with the World Bank, captures a transfer of information in a very simple and neat and adequate way. The 5 pillars that we like to talk about is to define what is green, to show how you select which projects are green, to verify with external independent environmental experts that your thinking is in line with good and best practice. You need to have a system to monitor your projects and to report on them. It's quite simple, but each step is hugely important to make this transfer of knowledge and information credible, to make it possible for the people with the money to put their money to work for green projects. The challenge, however, is that the vast amount of private capital is still managed with a fiduciary mandate. And I just took this slide from our investor presentation to show you, focus is still on the financial risks. Keeping credit losses low is very important, and it will continue to be so. And the same goes for the investors we're talking about here. 98% of them have a primary goal to deliver maximum risk-adjusted returns to their future pensioners, etc. If they sign PRI, it means that when they have 2 investment opportunities that have equal risk and equal returns, and one of them has ESG features, they will definitely choose that. And that's what we're seeing on the green bond market, with a huge demand for green products. Now, for the ones who get access to these investors, even if it's true that the vast majority of private investors still have the fiduciary mandate as a number 1, it gives you an additional twist if you can integrate ESG into your financial products. And we've heard many of the previous speakers talk about how the financial strength can be supported, be it by diversifying the investor base, getting stronger relationships to investors that will put you in a safer position when it turns nasty on the financial markets next time. You can maybe extend your maturities. So making your financing product green is not going to be a complete game changer so that you're treated like a AAA while your financial risk is a AA, but it will be a smoothening factor that creates financial strength for you. And that's where I would like to stop.